University. I'm the one, the only Neil Pathakar, and in this video, I'm going to educate you on dollar cost averaging. Dollar cost averaging is an investment strategy where you make periodic incremental positions to average out into a mean. This is an effort that can be applied on many accounts in order to limit the risk during volatile markets. An example of this can be on Apple. For example, you get one share of Apple per week. And let's say for this entire stretch of time, you were buying one share of Apple. One share here, 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 one share, etc. So now, when you get into today, all of your position of 40 shares is at 328, and now you're up a big return. So there is minimal risk to the downside because you're taking an average of a bunch of positions. It is used when the market is volatile, like today, where it can go up, down, and continue going up. However, it makes your average come back to a nice mean. I like this strategy because you get to get that entire position and you're not going to lose too much, and it's a conscious effort to continue to buy. So I apply this strategy a lot of times on these large market cap stocks that'll continue to grow over time. So the advantage of position size averaging is that the overall small positions, one share a week, even one share a month, average up to be a big time gain. This can be applied on example of Zoom. Initially, when you were looking at this explosive stock, you see how it was building, pull back hard, building, pull back hard. Well, who knows if you get in here with your entire position, what if I lose all that money? Well, this strategy prevents that because you're getting a share periodically and it's going along this curve, but in the long term, you have a feeling on this bullish outlook. So your gain and position will only be around the 180 to 200, but now as the continued growth occurs, even with minor pullbacks, you continue to buy during those times, which allows a small stock to make you a big return. So there's a lower risk when it goes down and a greater risk when greater gain when you're right. But however, there are disadvantages to this. Pull up Uber stock, for example. There is no real periodic trend. So if you continue to buy shares all throughout, you don't have a big gain or a big loss. I mean, that's a little bit of a disadvantage because you took all that money and you invested it all into Uber over a long stretch of time just to be at the same price you were initially at. And this is kind of contradicting the pattern because you kind of want a one-sided move over the longer term. But now you've got a big position on Uber that isn't going to make or break you. However, you want to see a nice return in the near future. That is an important lesson on dollar cost averaging.